Welcome back to Accounting 301 Financial Accounting. Professor Morgan-Nance here. Before watching this video, you should have read Chapter 3 and watched the interactive presentation so that you will be familiar with the concepts we will be discussing. This is a fairly rigorous chapter again. So in Chapter 3, we will learn about the final steps in getting our accounting records ready to be published for external users. We need to look at the timing of the transactions and make some adjustments to make the accounting records compliant with GAAP. That would be generally accepted accounting principles. I consider this chapter to be about cleaning up the books. This chapter also covers the end of the accounting cycle, the closing journals that are recorded at the end of the year to reset the company's scoreboard to 0 to prepare for the next year's business. And finally, this chapter introduces the concepts of current assets and current liabilities to help us evaluate a company's liquidity. In other words, how easily a company can pay its short-term bills. As we've discussed previously, learning objectives are like a roadmap. They tell you where you're going and remind you where you've been. With that in mind, please review these learning objectives as you progress through the chapter to ensure you're on track. The first part of the chapter focuses on the housekeeping accountants do at the end of the period to adjust the accounting records to be compliant with generally accepted accounting principles, GAAP for short. We talked about accounting periods in prior chapters, as you are aware. The most common accounting period then is 1 year. Companies also prepare monthly reports, quarterly reports, and semi-annual reports. At the end of each year, most companies prepare an annual report of operations and financial position, also known as the income statement and balance sheet. The fact that we divide our financial reporting into fixed periods of time, such as a month or a quarter or a year, means it is necessary to make special adjustments for transactions that cross from one time period into the next. Remember the revenue recognition and the matching principles from Chapter 1? Those two principles require that we be extra careful to record accounting information in the proper time periods using accrual-based accounting. As we practice in homework, you will find that most of our example time periods are 1 month, although a few are 1 year. So this will help us to practice and learn the time period idea. Now, the accrual basis of accounting says that revenues must be recognized when earned and expenses must be recognized when incurred. The accrual basis of accounting is considered to be in compliance with generally accepted accounting principles. The cash basis of accounting says that revenues be recognized when cash is actually received and that expenses are recorded when cash is paid. Cash basis accounting is what we are used to in our personal lives, but the cash basis is not considered to be compliant with either U.S. GAAP nor IFRS, and almost all companies use the accrual basis of accounting. So here is an example of why the cash basis does not provide accurate information financially. This example isolates one expense, insurance. On December 1st, 2015, Assume Fast Forward Company paid $2,400 in cash for a 24-month business insurance policy. If this information is reported using the cash basis of accounting, the entire $2,400 would be recognized as an expense in 2015, even though the policy provides protection for 2015, for 2016, and for 11 months of 2017. The impact of recording the entire $2,400 to insurance expense in 2015 would not be good. Net income would be artificially low in 2015. Only 1 month of insurance would have been used up by December 31st, but all 24 months of insurance would have been reported in the income statement. Not good. Conversely, net income in 2016 and 2017 would be artificially high because no insurance expense would have been recorded at all in those years. These distortions to net income are caused by timing of when we buy the insurance compared to when we use up the insurance. The distortions are also part of the reason companies use the accrual basis of accounting. So using the same example, on the accrual basis, we would initially record a prepaid asset for $2,400. Prepaid asset is on the balance sheet. Then, using adjusting entries, we will systematically record $100 of insurance expense in the month of December 2015, $100 for each month in 2016, and $100 for the months January through November in 2017. That's 24 months of insurance month by month. We would match the expense of $100 per month with the periods benefited by the insurance coverage. This is a far better matching of revenues and expenses. You've just learned there are some challenges associated with how we record transactions when cash is received before or after revenue is recognized or expenses incurred. In the next section, we will discuss the adjustments necessary to address those issues. And first, let's revisit some concepts we learned in Chapter 1 about revenues, expenses, assets, and liabilities. With accrual basis accounting, we recognize revenue when the product or service is delivered to our customer, and this is called the revenue recognition principle. The matching principle aims to record expenses in the same accounting period as the revenues that are earned as a result of those expenses. So this matching of expenses with revenues is a major part of the adjusting process. Furthermore, with respect to the balance sheet, assets are reported in the amount that represents the economic benefit left to us at the end of the period. In the case of the insurance policy, we owned 23 months worth or $2,300 worth of benefits remaining at December 31st, 2015. And finally, liabilities are reported at the amount we owe to someone else at the end of the period. Companies make adjusting entries at the end of an accounting period to correct their accounts for transactions or events that are not yet recorded. Rather than give you an endless list of examples, I'd rather you think about grouping adjustments based on the timing of cash receipts or cash payments in relation to the recognition of related revenues or expenses. There are two broad categories of adjustments. The first is when we pay or receive cash before the expense or revenue is recognized. This category includes prepaid or deferred expenses, including depreciation, and unearned or deferred revenues. Deferrals are things that are already recorded on the books but need to be cleaned up to make the expense or revenue match with the proper time period. They are called deferrals because recognition of an expense or revenue is deferred until sometime after the cash is actually received or paid. We will discuss the process for accounting for prepaid insurance, supplies, and depreciation. Now, conversely, sometimes transactions or events have occurred, but cash has not been exchanged. The second major category of adjustments, then, is when cash is paid or received after the expense or revenue is recognized on the books. These transactions are unrecorded in the accounting records until we make accrual adjustments to record revenues and expenses. These are some very common types of adjustments. The category includes accrued expenses and accrued revenues. In other words, accruals are transactions that are not yet recorded on the books, but should be. Over the past several semesters, students in my classes have asked for clarification about the words incur, defer, and accrue. I've included this slide and the next two for your review. Um, I'm not going to read them out loud to you, but I will flip through them and then let's move on to adjusting journal entries. Occur, incur, definitions for defer, and for accrue. While we've discussed the first 2 points on this slide about adjusting journal entries, I want to share 2 important rules about adjustments that will keep you out of trouble on your homework and more importantly on the exam. This is at the bottom of the slide. First, every adjusting journal entry involves an income statement account and a balance sheet account. For example, you should never record an adjusting journal entry using 2 balance sheet accounts but no income statement account, or 2 income statement accounts and no balance sheet account. Okay, rule 1. Rule 2, adjusting journal entries generally don't involve cash. Therefore, when you review your adjusting journal entries for accuracy, make certain the cash account is not one of the accounts you are adjusting. And finally, don't forget this point, adjusting journal entries must be posted to the general ledger just like regular journal entries are. In the real world, when working on month-end financial statements, I will first review the accounts on the trial balance to ascertain which accounts need cleanup work. The adjustment process requires that we compare the balance of an account to be adjusted with what the account balance should be and make an adjustment for the difference. The insurance example we talked about earlier was a type of deferral called prepaid insurance. For all adjustments involving prepaid expenses, such as prepaid insurance or rent or supplies, we increase or debit an expense account and reduce or credit an asset account. The following slides depict examples of typical adjusting entries. And please also have a careful look in the textbook at the deferral adjustments that are illustrated on pages 103 through 108 to help you understand how they work. As you recall from the earlier example, we paid for 24 months of insurance in advance and properly recorded the transaction with a debit to prepaid insurance, which you see here, and a credit to cash. However, the prepaid insurance account needs to be cleaned up because some of the insurance has been used during the time period the financial statements cover. The insurance used up is removed as an asset and moved over to the income statement as an expense to reflect the amount used up. In our adjusting journal entry at December 31st, we will debit or increase insurance expense account for $100, which is 1/24 of 2,400, and we will credit or reduce the prepaid asset, the asset prepaid insurance. Here's our journal entry. Please don't forget, once all adjusting journal entries are recorded in the general journal, we must post them to the general ledger so that the account balances will be correct. In our next example, let's assume Scott Company spent $9,720 on supplies during 2013. When the supplies were purchased, they were put in the supply room to be used in the business. At the time, an entry was made to debit or increase an asset account called supplies and credit the cash account. We can see the debit to the supplies account right here. Now, during the time period since the company bought the supplies, this is a few months, employees have gone into the supply room and removed supplies to use in the business. On December 31st, an employee counts the supplies and adds up its cost and determines supplies remain in the supply room of $8,670. Uh-oh. Our books say we have more supplies than we actually do. The books say we have 9,720. We now need to clean up the supplies asset account to reflect that we don't really have $9,720 of supplies in the supply room anymore. We only have $8,670 worth of supplies. The difference between the two amounts, $1,050, is the amount that employees used in the business. So we clean up or adjust the supplies to reduce the asset account, the supplies account, by $1,050 with a credit, and reflect expense with a debit of $1,050. Other prepaid expenses are accounted for exactly the same way. Okay, fairly straightforward. In the interest of time, let's end what we'll call the first part of part one here. And in a few minutes, let's look at another special type of deferral adjusting entry called depreciation. Thank you, and I'll see you in part 1B.